I was sitting in my office on the 47th floor of JPMorgan Chase headquarters when the call came in. It was September 2008. Lehman Brothers had just collapsed. Bear Stearns was gone. The entire financial system was on the verge of complete meltdown. And while other banks were scrambling, panicking, making desperate phone calls to the Federal Reserve, I was calm, not because I wasn't scared. Hell, we were all scared, but because we had prepared. We had a plan. We had done exactly what I'm about to share with you today. The temperature in that boardroom felt like it dropped 10 degrees when my chief risk officer walked in with the latest numbers. Jamie, he said, his voice barely above a whisper, Lehman's gone. AIG needs $85 billion or they're next. And the credit markets, they've completely frozen. I looked around the room at the faces of my senior executives. These were people who had seen everything, lived through multiple crises, managed hundreds of billions in assets, and they were terrified. But you know what I felt? Opportunity. Because while chaos reigned in every other corner of Wall Street, JPMorgan Chase was ready. We had cash, we had liquidity, we had prepared for exactly this moment, and by the time the smoke cleared, we hadn't just survived, we had thrived. A recession is coming. I've said it publicly, and I'll say it again. It's not a matter of if, it's a matter of when. The economic indicators are flashing red like a Christmas tree. Corporate debt levels are at historic highs, higher than they were in 2007. Consumer spending is slowing, despite what the headlines tell you. The Federal Reserve is walking a tightrope between crushing inflation and triggering a recession, and frankly, they're running out of rope. The geopolitical tensions we're seeing, the war in Ukraine, tensions with China, instability in the Middle East, any one of these could trigger something much bigger than just a mild economic downturn. But here's the thing that separated JPMorgan from every other major bank during the 2008 crisis. And it's the same thing that's going to separate winners from losers in the next recession. Preparation beats prediction every single time. I've lived through 5 major recessions as a banking executive, and each one taught me something critical about survival, opportunity, and what it really means to build lasting wealth during economic chaos. Today, I'm going to share the 5 strategies that not only helped JPMorgan survive the worst financial crisis since the Great Depression, but actually emerge stronger, more profitable, and with greater market share than we had before. These aren't theoretical concepts. These aren't academic strategies you read about in business school. These are battle-tested tactics that we used to deploy billions of dollars when everyone else was paralyzed with fear. Strategy #1, build your cash fortress. Let me tell you something that might sound counterintuitive, maybe even stupid if you listen to most financial advisors today. Right now, while everyone's chasing yields, while everyone's putting their money into stocks and bonds and crypto and real estate, while everyone's talking about how cash is trash and inflation is eating away at savings, you need to be doing the opposite. You need to be building cash, real cash, liquid, accessible, ready to deploy cash. I remember walking into the JPMorgan Treasury Department in early 2007. The economy was still booming. Real estate prices were hitting new highs every month. The stock market was making new records. Credit was flowing like water. And we had about $80 billion in cash and short-term liquid assets sitting on our balance sheet. My CFO at the time, Mike Kavanagh, said, Jamie, we're sitting on too much cash. We're missing opportunities. Our return on equity is suffering compared to our competitors. Goldman is leveraged 30-1 and making incredible returns. Lehman is at 40-1. We look conservative by comparison. And I said, good, keep building it. My team thought I was losing my mind. Here we were, one of the biggest banks in the world, and I was telling them to hoard cash like we were expecting the apocalypse. But I had learned something during my years at Bank One, something that most Wall Street executives seem to have forgotten. Cash isn't just an asset. During a crisis, cash becomes a weapon. By the time September 2008 rolled around, we had over $150 billion in liquidity. That's not just cash sitting in vaults. That's cash, short-term Treasury securities, overnight deposits, and immediately available credit lines. $150 billion that we could deploy at a moment's notice. Do you know what that meant when the entire financial system was collapsing? While Lehman Brothers was begging for emergency funding from the Federal Reserve, while Merrill Lynch was selling itself to Bank of America in a desperate fire sale, while AIG was on its knees asking for an $85 billion government bailout, we were the buyer. We acquired Bear Stearns for $2 a share, a company that had been worth $133 a share just over a year before. We bought Washington Mutual's assets for $1.9 billion when the company had been valued at over $40 billion just months earlier. We picked up prime Manhattan real estate, hired the most talented employees from failing competitors, and captured market share at pennies on the dollar. But Jamie, you might be thinking keeping cash means losing money to inflation. You're absolutely right. Cash is a terrible long-term investment. Over the past decade, with inflation running at 2 to 3% annually, cash has been a guaranteed loser. But during a recession, especially during a financial crisis, cash becomes the most powerful asset in the world. It becomes your ammunition when everyone else is out of bullets. It becomes your lifeline when everyone else is drowning. It becomes your competitive advantage when everyone else is fighting just to survive. Here's exactly what I recommend, and these are the same principles we apply to JPMorgan's balance sheet management. Start building your cash position now, before you need it, before the recession hits, before asset prices start falling. Keep 6 to 12 months of expenses in immediately accessible accounts, savings accounts, money market funds, short-term CDs. This is your survival cash, your insurance policy against job loss or income disruption. But go beyond that survival fund. If you're an investor, if you have any money beyond your immediate needs, keep 20 to 30% of your investable assets in cash or cash equivalents, money market funds earning 4 to 5%, short-term treasury bills, high-yield savings accounts. Yes, you'll earn less than if you were fully invested in stocks returning 8 to 10% annually. But when the recession hits, when asset prices crash by 30, 40, 50%, like they did in 2008, you'll be the one buying while everyone else is desperately selling. Think about it this way. Would you rather have $100,000 earning 4% in a money market fund, or would you rather have $70,000 left after your stock portfolio gets crushed in a market crash? The math is simple, but the psychology is hard. Most people can't bring themselves to hold cash because they're afraid of missing out on gains. But successful investors, successful banks, successful businesses, they understand that sometimes the best defense is a good defense. Strategy #2, the contrarian's playbook, buy when others panic. March 2009. I'll never forget that month as long as I live. The S&P 500 had fallen 57% from its peak. The Dow Jones had dropped from over 14,000 to under 6,600. Unemployment was soaring past 10%. Home prices were in absolute free fall, down 30% nationally and still falling. Bank stocks were trading like they were going to zero. The media was calling it the end of capitalism as we know it. I remember watching CNBC and seeing grown men, seasoned financial professionals, nearly in tears, talking about the complete collapse of the American financial system. And what did I do? I went on television multiple times and said, this is the time to buy American. This is when you buy stocks, not when you sell them. People thought I was absolutely crazy. I got hate mail. I got angry phone calls from JPMorgan shareholders asking if I had lost my mind. Even some of my own board members questioned whether I was being too aggressive, too optimistic in the face of what looked like a complete economic meltdown. But here's what I knew that others didn't. What 40 years in banking had taught me: fear creates opportunity. When everyone is selling, when panic has completely taken over, when the headlines are screaming about the end of the world and people are talking about the next Great Depression, that's when the best investments become available at the best prices. The key is having the cash and the courage to act when everyone else is frozen with terror. Let me give you some specific examples of what we bought during that period, because these numbers will blow your mind. Bank of America stock was trading at $3 per share in March 2009. Today, it's over $30. Citigroup hit a low of 97 cents. Yes, less than $1 per share. General Electric, one of America's most iconic companies, fell to under $6. Apple, and this was already after the iPhone had launched, dropped to $12 per share. Amazon was trading at $35. Google fell to $247. These weren't speculative companies. These weren't penny stocks or fly-by-night operations. These were some of the biggest, most established, most profitable companies in the world. And they were trading like they were going out of business. Why? Pure panic, pure emotion. People were selling everything just to get to cash, just to feel safe, just to stop the pain of watching their portfolios drop every single day. During recessions, 3 types of assets become incredibly attractive. And I want you to write these down because this is exactly what we look for when we're deploying capital during a crisis. First, high-quality dividend-paying stocks of essential companies, utilities that provide electricity and water, consumer staples like Procter & Gamble and Johnson & Johnson, healthcare companies that people need regardless of economic conditions. These companies often see their stock prices cut in half or more, during panics, but their underlying businesses remain fundamentally strong. Their dividends might get cut temporarily, but they often increase during the recovery phase. Second, real estate. But I'm not talking about speculative real estate, vacation homes, or commercial real estate in declining areas. I'm talking about prime residential real estate in good neighborhoods with strong job markets, rental properties with solid cash flows and stable tenants, REITs focused on essential infrastructure like data centers, cell phone towers, and distribution warehouses. During the 2008 crisis, we saw Manhattan apartments selling for 40% below their 2006 prices. Today, those same apartments are worth 150% more than their recession lows. That's a 250% total return for investors who had the cash and courage to buy when everyone else was scared. Third, distressed debt and special situations. This requires more sophistication, more due diligence, but during recessions, you could find corporate bonds from solid companies trading at 60 minus cents on the dollar. These aren't companies going bankrupt. These are companies facing temporary liquidity issues, companies whose access to credit markets has been cut off by panic, not by fundamental business problems. You can find preferred stocks yielding 12 to 15% from companies that will survive and thrive once credit markets normalize. But here's a critical part, and this is where most people fail, where even sophisticated investors make mistakes. You have to start buying gradually. Don't try to time the bottom perfectly. Nobody can do that. I couldn't do it. Warren Buffett couldn't do it. The Federal Reserve couldn't do it. Start buying when things look bad. Buy more when they look worse. And buy even more when they look completely hopeless. This is called dollar cost averaging into the crisis. And it's exactly how we deployed billions of dollars during 2008 and 2009. Strategy #3, recession-proof your income, something most people don't think about until it's too late, until the pink slip is already on their desk. Your job might disappear during a recession. And I'm not talking about just blue-collar jobs or retail workers or people in obviously cyclical industries. I'm talking about professional jobs, management positions, even executive roles. We laid off over 9,000 people across JPMorgan during 2008 and 2009. Good people, talented people, people with MBAs from top schools, people who had never been unemployed a day in their adult lives. But that's what recessions do. They force companies to cut costs wherever they can. And the biggest cost for most companies is personnel. Even profitable companies, even companies that survive and thrive during recessions, they still cut jobs because their revenue drops, their margins get squeezed, their access to credit gets restricted. It's just basic business survival. This is why you need to recession-proof your income before the recession hits. And there are several specific ways to do this. First, make yourself indispensable at your current job. Don't just be competent, be irreplaceable. Become the person who generates revenue, not just manages costs. Become the person who brings in new clients, who manages the most important customer relationships, who solves the problems that nobody else can solve. During layoffs, these people get kept. During recoveries, these people get promoted. I learned this lesson early in my career at American Express. During the 1990 to 1991 recession, I watched talented people get laid off, while others, sometimes less technically skilled but more strategically valuable, kept their jobs and advanced their careers. The difference wasn't intelligence or education or even experience. It was strategic positioning within the organization. Second, develop multiple income streams. And I mean real income streams, not side hustles that bring in $200 a month. This might mean freelance consulting in your area of expertise, taking on projects that leverage the skills and relationships you've built in your full-time career. It might mean rental income from real estate investments, buying properties that generate positive cash flow after all expenses. It might mean dividend income from a well-constructed portfolio of blue-chip stocks that pay reliable quarterly distributions. It might mean a legitimate side business that can operate independently of your main career and potentially scale during a recession when people are looking for value and efficiency. The goal is to ensure that if one income source disappears, you have others to fall back on, others that can potentially grow to replace your lost employment income. I know people who lost six-figure jobs during 2008, but were able to maintain their lifestyle and even grow their wealth because they had built multiple income streams that continued producing even when their primary employment ended. Third, invest in recession-resistant skills and credentials. Technology skills that help companies become more efficient, data analysis, process automation, digital marketing, cybersecurity, healthcare skills that serve essential human needs, nursing, physical therapy, medical technology, essential services skills, plumbing, electrical work, HVAC repair, accounting, legal services. During every recession, certain sectors not only survive, but actually see increased demand. In 2008, while the finance industry was collapsing and construction was in free fall, technology companies that help businesses reduce costs and improve efficiency saw their demand increase. Cloud computing companies, software as a service providers, business process optimization consultants, these sectors actually grew during the recession because companies needed their services to survive. But here's something even more important, something that most people miss. Use the recession to upgrade your skills and positioning. While your competitors are just trying to survive, while they're cutting their training budgets and reducing their professional development, you should be investing in yourself more aggressively than ever. Get that MBA you've been putting off. Earn those professional certifications that distinguish you in your field. Build that professional network you've been meaning to develop. Learn new skills that will be in high demand during the recovery. Because when the recovery comes, and it always comes, you want to be positioned for the opportunities that follow. The best jobs, the best business opportunities, the best investment opportunities often emerge during the early stages of recovery, and they go to people who prepared during the downturn. Strategy #4, the JPMorgan debt strategy. One of the most dangerous things you can have entering a recession is bad debt. High interest debt, variable rate debt, debt that requires regular refinancing, debt with restrictive covenants that can trigger if your income drops or asset values decline. This kind of debt can absolutely destroy you when credit markets freeze up, when interest rates spike, when lenders get scared and start calling in loans. I've seen it happen to individuals, small businesses, and even large corporations. Companies that were profitable and growing suddenly find themselves unable to refinance their debt, unable to meet their loan covenants, forced into bankruptcy, not because their businesses failed, but because their debt structure was unsustainable during a crisis. Here's exactly what we did at JPMorgan starting in 2006, 2 years before the crisis hit. We systematically reduced our leverage and improved our debt quality. We paid down expensive debt and replaced it with cheaper alternatives. We extended our debt maturity so we wouldn't be forced to refinance during a crisis when credit markets might be frozen. We negotiated flexible covenants that wouldn't trigger if our business temporarily declined. And most importantly, we moved from variable rate debt to fixed rate debt, locking in historically low rates before they could rise. By the time 2008 arrived, we had one of the strongest balance sheets on Wall Street. Our debt to equity ratio was lower than most of our competitors. Our average debt maturity was longer. Our interest coverage ratio was higher. We had more cash and less refinancing risk. This wasn't just financial prudence, this was strategic positioning for crisis conditions. You need to do the same thing with your personal finances, and you need to do it now before the next recession hits. First, pay off all high interest debt, immediately credit cards charging 18 to 25%, personal loans, variable rate loans, anything above 8 to 10% interest. This isn't just about saving money on interest payments, although that's important. It's about reducing your fixed monthly obligations so you have more cash flow flexibility during tough economic times. Think about it this way. If you're paying $500 per month in credit card payments and $300 per month on a personal loan, that's $800 in monthly obligations that don't provide any flexibility. But if you pay off those debts, suddenly you have an extra $800 per month that you can redirect toward essential expenses, emergency savings, or investment opportunities. Second, if you have a mortgage, consider refinancing to a fixed rate if you haven't already, and consider extending the term even if it costs more in total interest over the life of the loan. I know this sounds counterintuitive. Every financial advisor tells you to get the shortest term possible to minimize total interest. But during a recession, cash flow is more important than total cost. A 30-year fixed mortgage at 4.5% gives you much more monthly cash flow flexibility than a 15-year mortgage at 4%. And that flexibility can be the difference between surviving a job loss and losing your home. Third, establish credit lines before you need them while your income is strong and your credit score is high. Get a home equity line of credit while property values are still elevated. Get personal lines of credit from multiple banks. Get business credit lines if you're self-employed, not to use immediately, but to have available if you need them during an emergency. Here's something most people don't understand about credit markets during recessions. Banks stop lending to everyone, even creditworthy borrowers, even people who have never missed a payment. In 2008, we saw people with 800 credit scores and stable employment get turned down for mortgages and car loans because banks were so scared of default risk that they basically stopped lending entirely. The time to get access to credit is when you don't need it, when economic conditions are good and banks are competing for your business. But here's the most sophisticated part of the debt strategy. Something that separates wealthy investors from everyone else: use cheap debt strategically to acquire appreciating assets during the recession. When interest rates are low and asset prices are falling, intelligent leverage can dramatically accelerate your wealth building. We use this exact strategy to acquire billions in distressed assets during 2008 to 2009. We borrowed money at 2 to 3% and used it to buy assets yielding 8 to 12%, creating immediate positive cash flow and long-term appreciation. You can use the same strategy on a smaller scale, borrow against your home equity at 4%, and use the proceeds to buy dividend-paying stocks, yielding 6 to 8%. Use portfolio margin to buy real estate investment trusts, trading at huge discounts. Take out low-interest business loans to acquire distressed rental properties, generating positive cash flow. The key is to borrow cheap money to buy income-producing assets, not to fund consumption or speculation. This strategy requires discipline, research, and risk management, but it's how significant wealth gets built during economic crises. Strategy, #5, the recovery positioning. Here's what most people get completely wrong about recessions, and it's the mistake that keeps them from building real wealth during economic downturns. They prepare for the recession itself, but they don't position themselves for the inevitable recovery. And the recovery phase is where the real money gets made, where fortunes are built, where strategic positioning during the crisis pays off exponentially. I learned this lesson during the 1990 to 1991 recession. I first, as a senior banking executive at Bank One, the companies and individuals who not only survived that recession, but emerged stronger, wealthier, and more successful were those who had positioned themselves specifically to benefit from the eventual turnaround. They didn't just hunker down and wait for the storm to pass. They prepared to catch the wind when it started blowing in their favor again. Let me share something that might surprise you about our investment strategy during 2008 to 2009. Some of the best performing assets in JPMorgan's portfolio weren't the defensive holdings that maintained their value during the crisis. They were the assets that got absolutely crushed, down 70, 80, even 90%, but had strong underlying fundamentals and huge recovery potential. Bank stocks, energy companies, real estate investment trusts, small cap growth companies, emerging market securities. These assets fell dramatically during the crisis, but then returned 300, 400, sometimes 500% during the recovery phase. Goldman Sachs stock, which we bought at $47 per share in late 2008, peaked at over $200 just 3 years later. JPMorgan's own stock, which fell to $14 during the crisis, recovered to over $60 by 2013. Energy companies that were trading like they were going bankrupt returned 10 minus 15 times investors' money during the shale oil boom that followed the recession. The key to recovery positioning is patience, conviction, and strategic thinking. You buy quality assets when they're beaten down to irrational levels, and then you wait, not for weeks or months, for years. The recovery from 2008 took 5 full years to completely unfold. The companies and investors who bought distressed assets in 2009 weren't seeing their full returns until 2013 to 2014. But here's exactly how you position for the recovery, the specific steps we follow at JPMorgan, and that you can apply to your personal investment strategy. First, identify sectors and companies that will benefit from post-recession structural changes. After every recession, there are major shifts in the economy. New technologies get adopted faster because companies are forced to become more efficient. Inefficient competitors get eliminated, creating market share opportunities for survivors. Consumer behaviors change permanently, creating new business models and investment opportunities. After 2008, we saw massive shifts toward mobile technology, cloud computing, online retail, energy efficiency, and cost-effective healthcare delivery. The companies that recognized and positioned for these trends early generated extraordinary returns for their investors. Amazon's stock price increased tenfold in the decade following the recession. Apple became the most valuable company in the world. Netflix revolutionized entertainment. Tesla transformed the automotive industry. Second, build relationships and maintain networks during the downturn. This might be the most important, most overlooked aspect of recovery positioning. Help people who are struggling. Maintain your professional relationships even when business is slow. Be the person others can count on for advice, support, and collaboration during difficult times. Because when the recovery comes, when new opportunities emerge, when businesses start growing and hiring again, opportunities will come through relationships more than any other source. The best job opportunities, the best investment opportunities, the best business partnerships, they get shared among trusted networks before they become public knowledge. Third, keep investing in yourself, your business, and your capabilities, even when times are tough and money is tight. This is counterintuitive because the natural instinct during a recession is to cut expenses and preserve cash. But this is exactly when your competitors are cutting back, when they're reducing their marketing spend, when they're laying off their best people, when they're postponing their growth initiatives. This creates enormous opportunities for those who can continue investing strategically. You can hire top talent that's been laid off by competitors. You can acquire customers from businesses that are cutting their service levels. You can capture market share from companies that are retrenching. You can build capabilities that will provide massive competitive advantages during the recovery. I'll tell you exactly what happened to JPMorgan after the 2008 crisis. And these numbers illustrate the power of recovery positioning. Because we had maintained our lending capabilities, because we had cash to deploy, because we had kept our best people and continued investing in technology and infrastructure, we were able to capture a disproportionate share of the business that came back during the recovery. Our market share in investment banking increased from 15% to over 25%. Our commercial lending portfolio grew by 40%. Our wealth management business expanded by 60%. Our return on equity jumped from negative numbers during the crisis to over 15% during the recovery. We didn't just get back to where we were before the recession. We became a stronger, more profitable, more dominant institution. The ultimate recession mindset. But all these strategies, the cash fortress, the contrarian investing, the income protection, the debt optimization, the recovery positioning, they all depend on one fundamental factor, mindset. And this is where I see most people, most investors, most business owners completely fail when economic conditions get challenging. They approach recessions with fear instead of opportunity. They think defensively instead of offensively. They focus on what they might lose instead of what they might gain. They react emotionally instead of thinking strategically. They follow the crowd instead of developing independent judgment. I want to share with you the exact mindset that has guided me through 5 major recessions and made JPMorgan Chase one of the strongest, most profitable banks in the world. Recessions are not disasters to be endured or survived. They are competitive opportunities to be seized and exploited. They separate the prepared from the unprepared, the strategic from the reactive, the long-term thinkers from the short-term panickers, the disciplined from the emotional. Every recession creates massive wealth transfers, not destruction, but redistribution. Money doesn't disappear during economic crises. It changes hands. Assets don't vanish. They get repriced and repositioned. Opportunities don't evaporate. They get redistributed to those who are prepared to recognize and capture them. The fundamental question you need to ask yourself is this: when the next recession hits, and it will hit, are you going to be on the receiving end of that wealth transfer, or are you going to be the one transferring your wealth to others who are better prepared? Start preparing now. Don't wait for the recession to be officially declared. Don't wait for the stock market to crash 30%. Don't wait for unemployment to spike or for credit markets to freeze. By then, it's too late to implement these strategies effectively. The time to build your cash fortress is now. The time to eliminate bad debt is now. The time to recession-proof your income is now. The time to study potential opportunities is now. Because when that recession does arrive, you want to be positioned like JPMorgan was in 2008, calm, prepared, liquid, and ready to act while everyone else is panicking.